Oh, you're very welcome, Dan, and thanks so much for the invite to come along and share some of my experiences with all of you here. A welcome for those of you from all over the globe. I'm currently speaking to you from Perth, Australia, which is a very wonderful part of the world. Just confirm that you can hear me okay, that would be great. And then we'll kick things off. Perfect. Thanks, Tom. Cheers, Tim. Thanks, James. All good. Okay, so look, my mission today really is to give you something that, as Dan said right at the start, something that is actionable right now in your trading, and also give you an opportunity to further build on that for those of you who choose to and are in the right place to do so. So I guess first things first is really just to tell you, Dan's given a tremendous introduction, thank you for the kind introduction, but really the bottom line is, and let's be honest here, is that the reality is the majority of traders don't make very much money. Okay, there's thousands upon thousands upon thousands of people trading markets, and generally speaking, invariably are disappointed. But most, if not many, know that it's possible to do so. And so really, my aim for today is to give you something, particularly those of you who are trading options, is to turn your possible into your reality. So what I've got today is really a mirror of what I do and what I've been doing for the last 20 years or so. And there's a couple of things I'm going to focus on that that may be a slightly new way of looking at things. There's one strategy I'm going to focus on and one approach I'm going to focus on, which to me have been the difference between people doing very well and just okay. And I'm assuming that most of you here would want to do very well, yes? So I guess first thing is that it will be really useful for me to know where you guys are coming from in terms of options trading. So if you can just type in whether you're a beginner, never traded options, some experience, or you've been trading options for decades, if you could just type that into the box, that would be fantastic to know, and just will help me pitch this in the right place, so making sure that all of you walk away with something that's useful. So that's great. Okay, just looking through. Thanks, guys. Okay, we've got a fair mix of experiences. Quite a few newbies. That's okay. Only FX. That's okay, Alex. We can. I can make reference to things which may relate to you too, because some of the principles I'm going to talk about do. Right, okay, that's great. Thanks, guys. I really appreciate your feedback there. It's obviously really important at this stage to say this is your webinar, okay? It's not mine. It's not the guys at Dan and his team. It's not their webinar. It's your webinar. So really, for you to get the maximum out of this, you ask as many questions as you can or you want. If anything that isn't clear that I say, please ask. And I would rather you did that and got something valuable out of the webinar than sit there scratching your head wondering what the heck this English bloke's talking about. So let's get things kicked off in earnest. That having been said, we will talk sort of live examples as we go through. Tim, I will share some magic, and James, yes, I will explain what I mean by lifestyle trading. So just a little about me. I'm not going to bang on about this because you've already had a lengthy and very generous introduction from Dan. 20 years of trader, which 10 years I've been working for various organizations as a consultant, coach, and teacher. Worked with Hawkeye Traders for almost 3 years now, and met Nigel Hawkes, who is the founder at an Australian Technical Analysis Association conference where I was presenting. What Hawkeye is based on, and therefore what most of the trading that you'll see in our Hawkeye Options Trader Learn Portfolio service is volume spread analysis. Now, I'm not going to talk in detail about that because we've got other things to talk about today, which are, but I would suggest that you by all means check out HawkeyeOptions.com and HawkeyeTraders.com at some stage if VSA is new to you. Originally from the UK, as you may have detected by the accent, it's not US based. Now living, as I said, in Australia. And look, because I'm a teacher, the thing that gives me the kick with all of this is I'm passionate about seeing others get results. So really, one of the benefits of doing what I do, and certainly all the one-on-one coaching I've done over the years, has been that I learn not just from my own experiences, and please let me be honest here, is that in my 20 years I've made just about every mistake there is to make. I've worn all the t-shirts you shouldn't really wear, but hopefully I've learned from some of those mistakes over the years. So I'll be sharing some mistakes as well that people make. But I've also experienced the trading lives of all of those people that I've worked with on a fairly intimate basis, as you could imagine being coached. So you're learning not just from my experiences, but the experiences of hundreds of other people as well. And so I would say that some of the traders I've worked with are exceptional traders, and some of the people, probably the majority, are those that struggle, know that it's possible, as I said before, but aren't quite hitting the mark with the results that they want to see. So what we're going to cover today is going to cover 3 option strategies, but the one we're going to focus on most of all is the explosive no money down setup, which I'm guessing is new to most of you. So I'm going to take my time in working through it because it's pretty sensational in terms of its possibilities, but also needs to be explained fully so you don't expose yourself to the risks associated with the strategy. I'll also give you the #1 trading business system for options, and what I mean by that is I'm sure all of you should be or want to be treating your trading as a business. So as you know, that every great business is based on great systems, and I'm going to tell you the #1 thing that really makes the difference between those who do exceptionally well and those who wish they did. And really, if you don't use this or don't feel that it's important, I'll give it up, okay? Because you're just going to spend the rest of your trading life struggling, and really for the investment in time you're making, you're not going to be getting the results that you need. So it really is that important. I can't stress it enough. But it is the #1. And then I'm going to talk about a professional trading business blueprint for adopting a lifestyle approach to trading, and that's what that's really what the basis of all of this is about. Great to see some questions coming in already, and John started the ball rolling. Is why are there so many educators traders recommend buying calls or puts when it starts a debit in your account? Well, John, you've got to view it as an investment. Really, it's not a debit as long as it doesn't go down. I mean, you're holding an asset which is worth value. It's no different really in principle to buying a share or even buying a house. Whenever you buy something as an investment, then you invest some capital in that idea, and subsequently, if the value of that underlying asset goes up, then it becomes worth more, and hence you can sell it at a profit. If it subsequently doesn't, then you take it on the nose and get out and run. So really, that's the principle of options in the same way it is of shares or buying and entering a forex position or buying a house or any investment at all. You're always, if you're putting some cash into an investment idea, then you're buying an asset, and really that's what you're doing when you're buying any option. That's a side issue. So what I'm going to do is just talk about what a professional trading business blueprint is all about. So these are some of the mistakes that people make. I mean, first mistake I see, and particularly in newer traders, is we've got an unbalanced focus on entry indicators. So what I mean by that is, if you look at all of the things you'll go to see, all of the things that you'll see when you go into forums. It's all entry, entry, entry. There's lots of fantastic charts with wonderful colors and dots and lines and whatever, whatever. And that's the focus. Whereas the actual purpose of entry is solely to give yourself a high probability that an investment or trading idea is going to go in your direction. That's it. It's what happens next that makes the difference. And so I would say 75% of the guys that I've worked with, it's not entry that's the problem. Of course they can tighten things up a little bit, but it's exit that's the issue. It's having that unbalanced focus on entry and not investing as much time, effort, and energy into exit. So that's really the first thing. So it moves away from that. It moves away from skipping from strategy to strategy, or even financial instrument to financial instrument, and system to system. Invariably what we find is when we look at somebody's trading record, and one of the things we may be offering going forward is looking at people's last 10 trades to see if we can see the patterns or the threads that are actually causing the issues for people. But more often than not, what happens is people have a trading system, and those who are enlightened will write that down, and those who are even more enlightened may even trade it. The problem is that most people shy away from trading their trading system completely, and when they go to measure it, and often don't measure it particularly well, they see it not working and subsequently blame the system. Whereas often this is unfair on the system, because the reality is that you've deviated from that system on a regular basis, and that means that you cannot possibly make a judgment on the system. You can only make a judgment on your trading plan, trading system, or any set of indicators to get in or out if you're trading them religiously, prospectively, not retrospectively, going forward with your money on the line. That is the only way you can tell whether a system works or not. And unfortunately, people's profit-loss columns are usually as a result, particularly if they're detrimental, usually as a result of them not following the system, not that the system doesn't work. A scattergun approach to trading, and what I mean by that is you just trade anything that moves almost. There are some, it's as important and a choice not to trade as it is to trade. It's an active choice to remove yourself from the market, to lessen the number of trades you have, as much as it is to increase or take a trade in the market. And so some people feel as though they want their money to be working all the time, and therefore will make sure that all of their capital is slammed into the market. This usually doesn't bode well for going forward. Give yourself permission give yourself permission to wait for the right trades to come along. And others use the force of some of the supernatural power to make trading business decisions. It always worries me greatly when I hear people who say they can feel the market. That is, usually that's testament to somebody who's gonna, if not already, are up for a big fall. And what we want to move away from is the enjoyment of trading to profitable trading. There's nothing wrong with enjoying the challenge of the market, but that shouldn't be what it's all about. At the end of the day, you're in business, in this case your trading business, to make a profit. It may not be a lazy, easy way to make money without you doing any work or learn, because there isn't a system on the planet which does that. So you can attend all the seminars you want, but unfortunately, unless you learn by osmosis rather than do some hard work, then you're not going to be successful. It may not be sexy and exciting, and ultimately, it may not be something that you'll hear often, because what you're up against is professional traders. And professional traders, let's be honest, would rather you were on the other side of success. Because if you're on the other side of success, it means that they're successful. They know how to play the game, and you need to put the work in that they have to be profitable. So that's what a trading business system blueprint is all about in principle. So it still involves using leading indicators for high probability entries. It still involves exits, exits, exits. As I said before, it is all about exits. It uses a range of option strategies to meet your trading goals. And this is one of, for those of you who are newer, this is one of the prime advantages of the exciting trading instrument you're looking at now, in that you have the opportunity not just to make money when the market goes up or down, as you do with shares or FX or futures, but you also have the ability to make money if it stays where it is, and a number of other strategies to suit different market conditions. And we're going to move on to this because it's really important. Enables, what it also does is it enables you trade, enables you to know just not just when to trade, but also, what to trade, but when and how to trade it. And it measures what you really must measure to produce a system that really works for you. There's no system I know of that's directly transferable from one individual to another individual to another individual, because each of you has different characteristics, different things that you're going to excel at, different things that you're going to struggle with. So really, what your mission from anything that you take on board from the fantastic speakers that you've got today is to put it into your own context and obviously subsequently test it before trading it. Or you can continue to trade against professional traders rather than becoming one. So there are two things I'm going to give you today to take two massive steps towards getting to where you can be as a trader from this professional business blueprint. Okay? And the first of these is the #1 trading business system for options trading success. It's critical. It's not optional. It's critical. Now, the problem is that what we've found is that many traders are what we'll call one-trick ponies, or at best two, meaning they only trade one strategy, whatever the underlying market is doing. This never works, okay? If you're just trading bought calls or covered calls, then you're not, or even bought puts, you're not going to make money from the market on a consistent basis. Most trading robots fail because although they may have periods of profit, they'll turn into a mechanical mess of despair and disappointment. So the #1 trading business system for options traders is the ability to match strategy to market. And by that I mean you've got this golf bag of clubs you can smack the market with, which are your different option strategies. You need to pick the right one for the conditions that you see in front of you. So what this means to you is, first of all, you're harnessing the power of multiple strategies, which is the real power, as I've said before, about this trading instrument. Secondly, you're harnessing the power of underlying market sentiment with solid, good, well thought out options positions. With this, you're going to have a blueprint for knowing exactly which strategy is most likely to be giving you the opportunity to make profit and manage risk. And the #2 trading business system you must master, by the way, is position sizing. And position sizing with options isn't quite as easy as perhaps it is for shares. But there is going to be an opportunity for us to go through this. But I'm going to give you some information that's going to help you. You can make a considered business decision with your open trades, whether you're over or under position for a specific market. And this is the first thing you should look at in your trading day. And here's the good news. It doesn't have to be complex. It can be simple. So what I'm going to do is just give you some examples of what I mean by this matching strategy to market. Let's use the example of a bought call, directional trading. So we're aiming to give ourselves the optimum chance of a move which is sufficient to produce profit. That should be most traders, not most trades. And so what will happen is most traders will scoot around a load of charts and see what fits, see if there's a buy signal anywhere, and dive straight in. But most successful traders will consider the market first. And let's take two simple things that would take you minutes to look at the start of your trading day to decide what might be the good thing to do. So let's use the S&P 500 and the VIX. And what we're asking ourselves is a particular strategy, bearing in mind the market conditions, a strategy that could work for us? And secondly, should we be position sizing normally or reduce the number of contracts of any position we enter based on underlying market conditions? So here's an example. So if we look at the daily S&P 500, the weekly S&P 500, the daily VIX, we can come up with a system. So if your daily S&P 500 is in uptrend and your weekly is in uptrend or neutral and the VIX is in downtrend or neutral, then obviously we're going to switch, we can switch bought calls on and we can position size to our max. If our daily S&P 500 is in neutral, but our weekly is still in uptrend, and our daily VIX is in downtrend or neutral, then again, we can trade bought calls, but we may position size a reduced level. So if we'd normally position size, let's say, 2% of our trading capital on a particular trade, then it may be that if the daily S&P 500 is in neutral, then we'll only position 1%. Obviously, if the daily S&P 500 is in downtrend or the daily VIX is in uptrend, then we don't trade bought calls. If you want to take it to the next level, we can add an extra system rule that says, well, look, if there's a potential strong resistance or a pivot high within 1% or 1.5% of the existing price point on the daily S&P 500, then we reduce position size. Because we can always accumulate further if we want to on any position, and there's a whole set of rules about accumulating, which I'm going to give for those of you going to move forward. I'm going to give you. Now we can get more sophisticated than this if we want to, but really, if you look back at the trades you've taken, for those of you who are already trading bought calls, if you look back at the trades you've taken over the last sort of, let's say, 4 or 5 months, and look at what the result will be if you adhere to this relatively simple rule, then I'm convinced you'll see a difference. Convinced you'll see a difference. There are 2 additional rules we would add going forward, which, again, I'll add for those of you moving forward with us. So once we've done this, then we can look at stock charts that might be a fit. Let's just briefly touch on credit spreads, because I know there are lots of guys out there saying credit spreads is the way to go, the only way to go, and because you're in a net credit situation, it's wonderful, da-da-da-da-da. But really, there are markets which are not suitable for credit spreads at all, and the problem with credit spreads is that it only takes, if you don't manage it well, it only takes 1 to remove 3 or 4 profitable credit spread trades. So make sure you know the instrument, the good and the bad, the strategy, the good and the bad, before you trade it. So the aim with credit spreads, for those of you less familiar, so we're talking about a bull put spread or a bear call spread, is to put the options legs away from the current market to scalp profit. So if, for example, we had a stock trading at $30, we may do a 28, 27 bull put spread, which would give us maybe 15, 18 cents credit, and then with the aim that that expires worthless and we retain that initial credit we brought in. There is a margin requirement associated with credit spreads, which should be seen as your investment, but we can talk about credit spreads in more detail at another stage. We still want to trade with the market, but with credit spreads, the ideal market condition is when volatility is relatively high but is dropping. And we're obviously looking very short term. So let's take the let's take the example of a bull call spread. So if we see our daily S&P 500 in uptrend or neutral, and our daily VIX in downtrend or neutral, then we can do a bull put spread. We can add an extra little rule in there that if we look at the VIX and it's less than 3% off the most recent pivot high, then we can position size normally. If it's less than that, then we've reduced our position size. And if we're in downtrend on the daily S&P 500 or uptrend on the VIX, we don't trade bull put spreads. And again, for those of you doing this, have a look at this as a rule against the trade you've taken and see what the result would be. And I'm convinced once again that that you'll see a difference. So what I'm not saying is credit spreads are bad. What I'm saying is that there are specific market conditions which suit credit spreads, and in fact suit every option strategy. There is a map that we can put together, or a blueprint to call it, which we can put together for every strategy, so you can take a look at the S&P 500 and the VIX and make the decisions about which strategy are fit for now. So let's look at yesterday's close on the S&P 500. So what we've seen is we saw this major Brexit dip, and then it recovered somewhat bizarrely within a week, which put us into downtrend. We're already in downtrend before this, so we really shouldn't have been entering bought calls, with the exception of one particular type of bought call, which we did enter, and I'll mention later perhaps. But then we went back into neutral, into congestion. This is the Hawkeye trend dot, which, sorry, I should have stated that. So green is uptrend, red is downtrend, white is in congestion or neutral. So at this stage, with the S&P 500 in neutral and a volume buying volume, then we could consider a bought call, perhaps. If we look at the weekly chart, we are in uptrend. Okay, so we've really been in uptrend since middle of April, although we're struggling to break 2100 on the S&P 500, and obviously today's action already is showing further weakness, but we're sort of trading in between this 2040, 2100 sort of range that we see here. Whoops. Sorry about that. That upset things a little bit. So if we go back to our system, well, look, we've got a neutral on the daily, and we've got an uptrend on the weekly. And if we look at the VIX, now for those of us who are less familiar with the VIX, that here, what the VIX measures is implied volatility of options traded on the CBOE. Now, so we've got an inverse relationship between this and the S&P 500. So the VIX is slightly leading on a lot of occasions, but also is, of course, a measure of volatility. Now, what we've got here is the VIX dropping, but in neutral. So here's our picture. We've got an S&P 500 which is daily is in neutral, weekly is in uptrend, VIX is in neutral, but dropping. So what that means is that bought calls, we could enter bought calls, although we'd struggle to find an entry. Or we could enter bull put spreads. Again, we may struggle to find an entry today, but it does mean that those particular strategies are acceptable, but with a lower position size. So armed with that information, how long would it have taken you to make that decision, and how much safer and how much potentially would you increase your profit potential overall and give you the confidence to make decisions if you had a system for every strategy, the blueprint for every strategy that that you can trade it? And really, trading the 8 most popular option strategies is enough for anybody, to be honest. So so yeah, so that's really what we're sort of about. So one of the missions that you have is to come up with a strategy, come up with a blueprint for every strategy based on that. If you do the work, and remember before I said you need to do the work, it's Mike the coach talking, you're not going to succeed unless you do the work. But if you do the work looking at whether this would have worked looking at your last 10 or 15 trades in terms of helping you take away those trades that didn't serve you well, then it's worth forward testing, surely. Now, you could do this yourself, or you could accelerate all that, because I'll give you them for those of you who are going to move forward. So it's your call. Now, I'm just going to have a quick look at the questions. We'll have a little questions break, if that's okay. Get on with it. Okay, cheers, Bob. Thanks. So yes, that's so we're looking to pocket the difference when premium goes up on our positions, John. Yeah. Makes sense? Yes, absolutely. So it's that combination of A, matching strategy to market, and then B, then when you're looking at specific positions, then away you go. Now, I did promise to give you an insight into the shares no money down strategy, so we're going to do this now. Just let me know, those of you who are familiar with covered calls already. Just type in a yes if you've done covered calls before. This is going to make, oh no, if you haven't, of course. Okay, there's a lot of you there. There's a lot of you there. That's cool, thank you. Okay, so I'll give a brief overview for those of you who haven't. So the idea of a covered call is that you buy some shares, and then every week or every month you sell a call, generating premium over the top of these. And really, it is that simple. So you profit either from the underlying share go up, or from the premium you make from a sold call, or both. Okay, and then you can choose, if you want to put in a long-term put protection, which means what some people do is they buy this put, which means they've got a capital loss on their shares, and the sold calls, maybe some of the sold calls will help pay for that put, and so they'll benefit accordingly. So the idea is that you have some shares and you make additional money by selling an out-of-the-money call over the top over the long term, with or without protection. So that's covered calls. However, although theoretically you can make between 2 and 4% per month, depending on what the underlying volatility of the market is, there are three main challenges, of which we'll focus on two. First of all, is the cost. To make a reasonable, life-changing amount of premium, the shareholding needs to be significant. So, for example, 10 contracts of a $30 stock means you've got a $30,000 holding in one position. Now, of course, we're not going to stick all our eggs in one basket, so you're going to need many tens of thousands to have an income which is going to be reasonable month in, month out. The major mistakes with covered calls is relates to the sold call management. It's very, very poorly taught. It needs to be robust right across the board, and a written trading plan that's followed needs to be in place. Just to give you an overview, then you don't have to sell a call. You can delay selling a call. So there's the right time to sell and the right time to hold off. If you hold off, it's called delay writing. And then there's altering the position intra-month by rolling up the option or rolling down the option, either to generate more premium to give yourself more protection on the downside, or to maximize the profit. Most don't do this well, to be honest, and looking at them. So there's a few issues there, not least the cost. And then, of course, you've got the cost of the put protection as well. Here's the explosive strategy idea. Now, this comes from something called synthetic options strategies, which hedge funds use quite regularly. So it's an idea taken from that and then adapted so that you and I can trade it and trade it well. James, you wouldn't usually sell a cover call at the same strike. You would usually sell one above out of the money as a general rule, unless the underlying was going down. But let's get to this. So here's the thing. What if, now remember I said that the money you have to outlay to invest in covered calls is usually quite significant. But what if you could have exactly the same one-for-one movement as the underlying share and it costs you nothing or near nothing? So you could enter Apple and it wouldn't cost you a cent. Would that be appealing? Or you could enter GE or Intel or Facebook and it still wouldn't cost you a cent. In fact, sometimes you'd even be paid for holding the position. So assuming that that sounds attractive, what then if you bought some put protection to cover your downside risk? So let's say we entered Facebook at 114, which it closed at yesterday. So we could buy an options position that mirrored that, and then put a 110 put underneath. So that's what we're talking about here. We're talking about investing nothing in our that's why it's no money down, in exposure to the movement of the share, and then put in some protection to protect on the downside. And then, as with covered calls, we can sell weekly and monthly calls over the top to generate a premium. Does that sound attractive? How many have heard of this before? Just type in yes if this is familiar to you, or no if it's not. Okay. Lots of no's. Right. So, essentially what we're doing is we're mirroring the idea of a covered call, but we're substituting the shares for a no money down position. And we're doing exactly the same thing. So we're generating exactly the same premium as we would if we managed sold calls where we're covered call. And we've still got the put protection in place. So this is how it works. Okay, and I'm going to go through this step by step for those of you who are less experienced. An at-the-money call position is what we mean by that, is if the underlying stock is trading at $30, then an at-the-money call position would be a $30 call. So it's around the same price as the underlying share. The delta on that position, and delta is how much the underlying option value moves for a 1 cent move in the underlying share. So the delta on an at-the-money position is invariably 0.5, which means that if the underlying share moves 20 cents, the option value will move 10 cents. So if we buy a long-term at-the-money position with a delta of 0.5, and it's a net debit long position, so it costs us, and let's say we bought it for $2 a share. If there's an increase in the value of the underlying share by $1, with delta being 0.5, we'd have a move in the call option by 50 cents. So if we chose to close that position down, our profit would be 50 cents for a $1 movement in the share price. If we then also sold an at-the-money put position, and the delta on that, because it's at the money, is also 0.5, we bring in $2 a share, because it's a net credit short position. If there's the same increase by $1 in the underlying share, there's the move in the put option by minus 50 cents. So we've brought in $2 to close that out. It's now worth $1.50, so we've made 50 cents profit. So we've made 50 cents profit from our bought call position, 50 cents profit for our sold put position, and so we have a $1 profit. That's 1 for 1 with the underlying share. And it's cost us nothing because our net investment in the call was $2. Our net credit in the put position was $2, equaling 0. So that's no money down, 1 for 1 movement with the underlying share. Now the ex-dividend, dividends will be taken into account, so sometimes the put will be more valuable because you're not going to get the dividends if you've got the options, but you get money in because the put is more valuable. Obviously, the downside to this, of course, is that if the share goes down, you will lose 1 for 1. So it's exactly the same as owning shares, except it's not costing you anything. How good is that? see the underlying go down one. No, we want to see the underlying go up $1 preferably. Okay. So here's an example. So here's again, this is on, now we're in silver position at the moment as a long call, which is in our portfolio, which is took back a wonderful 150% at the moment. I'm not sure what it's pre-market was slightly up. So let's look at what at a real example. Okay. So here's SLV. It's the ETF which tracks silver. For those of you less familiar, currently trading just 2 cents. Whoops, 2 cents under under $19. So if we look at a $19 call, there's the bid and the ask. So let's say it costs us 162 for our bought call position, and here's our sold put position. So we bring back in, let's say 157. So the net cost of this position would be 5 cents. Okay, we're investing. What did we say? 162. We're getting 157 in. So 5 cents cost. So that's what it's costing us to hold SLV per share. So if we invested in 10 contracts, rather than costing us $18,980, it would cost us $50. Okay, your call whether you want to spend 18,000 or 50 bucks, right? Then we can obviously sell calls over the top. So if we were to choose an August, we could, let's just for simplicity, let's just choose an August 20. Then we could sell an August an August 20 at, let's say, 55 cents. Okay, so the price of our no money down has been 5 cents. We've bought in 55 cents for it. Now, but we're not going to leave it like that for two reasons. First of all, there'll be a massive margin to pay, and secondly, we want to protect the position. So what we do is by December, if we've entered the 19, we buy December 18 put. So for the same length of time as our no money down position, for let's say 104, 105. Let's keep the math simple. So our investment is actually 110 in this position. So 105 for the protection, 5 cents for our no money down position, and we brought in 50 cents, 55 cents for our first sold call. Remember, of course, we can then subsequently sell September, October, November, and December calls before this position runs out. So at the end of the day, there may be some value left in this position, plus all the money that we've bought in for this sold call. Our maximum risk is the difference between, is the cost of the put and the difference between our no money down position and our put strike. We can't lose any more than that. So in this case, it would be $2. So we've already reduced our risk by 25%, even if it goes pear-shaped. And of course, with the opportunity to sell 4 extra calls, let's say, at 25% every time, then essentially we're protecting ourselves as we go, no matter where SLV goes. So that's the theory behind this, with a real trade example. We need to be careful of a few things. First of all, liquidity is an issue. We need to make sure that the options we're choosing are liquid enough to get a desired fill. There's 2 ways to use this, which will dictate how we set things up technically. We can choose a mercenary approach, or we can choose a long-term approach. And of course, if it turns to be a bear market, we can do a reverse no money down strategy, or reverse jaws as we call it, to trade the market downwards. Just with what we'd do then is we'd buy a put, sell a call as our no money down, which would mirror going short a stock, and then we'd buy a call as protection. We need the put, as I've said, because we want some protection. We would need to reduce the margin, cap the risk, and there's also a couple of variations in where we can put the put as well. The sold call, as I said before, really the management of the sold call is crucial. We may choose to delay right. We could roll up, roll down. We've got special treatment when a stock's going to go ex-dividend, so we don't get exercised early. And so we've got a trading plan component for each of these. And we can trade weekly or monthly depending on market conditions, of course. So just to reiterate, 1-for-1 movement with the underlying costs us nothing. We buy some put protection we usually enter in a 4 to 6 month trade. We buy some put protection for the whole time. Then we sell weekly or monthly calls over the top. But we must know correct setup, how to manage the risk, and how to manage the sold call. So here's another example. This is T. So AT&T from yesterday's prices again. So 43.35 was trading at yesterday. So the bulk call would have cost us, say, 165. The put, we were brought in 240, and that's because T's got a better dividend. So we actually get paid for holding this no money down position of 75 cents. Our put cost for our one strike below to cap our risk to that level will be 190. So our total investment in this position is 125. So if we sold an August 44 call with plenty of upside, then we'd bring in 48 cents per share or 38% return. And of course we can sell calls till January. Now, just if we wanted to close it, let's say it got up to 44 by August expiry, what that means is that it's gone up 65 cents. Okay? So we've made 65 cents on our no money down position, because remember it moves 1-for-1. We've made 48 cents on our sold call. So that's $1.13, if memory serves me correct. $1.13. We'd lose some on the put. We'd probably lose around about 30 cents on the put. So make about probably 85 cents for an investment of 125 in about 5 weeks. So that's about 67, 68% ROI, which is pretty impressive. I'm sure you'll agree. Just going to have a quick look. Questions? Is that making sense, guys? Always seem that the put premium is more expensive than the premium you'll get for selling a covered call, the same strike. That's because we're buying, remember this is a longer term position, the no money down is several months long, and that includes the put, okay? So this is the January series, okay? So we're buying our NMD January, no money down January 43. Then we're also buying a January put, because it's cheaper to buy for the whole length of time than it is month on month, although you could do it month on month like a collar if you wanted to. So we're investing this, we'll manage our risk for the duration of it, so we're only paying that cost once. Now sold call we're doing month on month on month, or even week on week on week. With silver, I think with our SLV position, if we did it, we'd probably make about 12% for a July expiry call, and then we could sell weekly, or we could be making 8 to 10% a week just on our sold calls if we wanted to do weekly rather than monthly. That sort of makes sense. So we're buying the put long term. So, look, I've just put another few examples, which again, I've not pulled these on my backside. I've taken these from real figures from last night. Facebook closed at 114 yesterday. If we did a no money down position at 115 for Jan, and then protected it with a 110 put, it would cost us, would make 50 cents credit with our no money down. Put cost is quite expensive, $8. So our investment in this will be $7.50 a share. But we make $2.20 for our sold call, so we made 30% return. So 5 contracts, it's costing us $3,750, and we're making $1,100. GPS, we're actually entered a diagonal call spread, which is not dissimilar to this type of strategy on this a couple of days ago. Yesterday closed at 21.27. So if we ended at 21 December no money down position, it would cost us 11 cents. The $20 put would cost us 180, so add those up. Our investment is 191 a share, a staggering 103 for a $22 August call which is a 52% return. It's just extraordinary. And so we've got our 10 contracts of 1,910, our total premium 1,030. GE closed at 31.45. Yesterday, we're doing a January expiry, $31 nominally down position, which cost us 8 cents. So it wasn't nominally down, it was 8 cents down. But I'm sure you can live with $8. $30 put, it was 128. So our investment is that plus that, so our investment is 136 per share. So 10 contracts would be $1,360, would make 48 cents on our August call, so 37% return. So let's put this into perspective, right? We've got exposure here to, essentially, if we bought 5 contracts of Facebook, 10 contracts of GPS, and 10 contracts of GE, that'll be over $1,000 worth of share exposure, $100,000 share exposure. It's cost us $7,020. So if we did it on covered calls, it'd be over 100,000 would be investing, 7,000 with no money down, and that really is the put costs, the protection costs. And bear in mind, if we were to protect these positions, then it would be exactly the same cost. It would actually be, let's say, 100,000 plus 7,000 put protection, which a lot of people do. They protect their long-term stock with puts. So we may be investing this anyway. So we're investing the cost of the puts rather than the cost of the shares, which costs us nothing, and we're bringing back exactly the same income. But rather than 2.7% for $100,000 investment, we're actually bringing $2,710 for a $7,000 investment on October the 19th, I think it is, October the 17th. So that's what it's all about. Okay, now what I want you to do is, for those of you who are newer, I may be sort of, it may be a little complex, but that's okay, because nothing sort of simple is going to make you a lot of money. Let's be honest. If you want the strategies that are going to serve you well, then you're going to have to do some work, as I said before. If you're already experienced and this is new, you're going to have to do some work to learn it. There are things which I stated before that you must know before you start playing with this. So there's 2 things that we've sort of covered today in some detail. First of all, we covered the blueprints for matching strategy to market. And secondly, we've covered no money down. But recognizing that some of you will be in a position where you want to know more, I've put together an unprecedented massive value in a kit, right, which is going to give you 2 immediate on-demand courses already. My favorite indicator course, which is 2.5 hours of content-rich learning, which talks about credit spreads, the pros and cons. It also talks about something called the wide bar, which is a hugely successful indicator for trading credit spreads with. The Trading Edge Review video set is 6 short trading modules which essentially go through what systems you need to have in place if you want to be treating your trading as a business. So it's almost like a checklist which you can then prioritize and start working to. So those 2 are on demand. Then the real kicker, the real sort of advantage of this is what we're going to do is we're going to do a live session which is all on no money down, next level. So we're going to reiterate. Everybody doing this will be sent a copy of the video covering the basics of the strategy. Okay, of today. What we're going to do is we're going to take that to the next level and go through example after example and give you the actual strategy setups that I use. We're going to look at the so-called management rules, which are so vitally important, and how to manage the 3 key risks associated with this strategy with confidence. Okay, so we're going to do that. It's a live session. And the second live session we're going to do is the exclusive professional trading business blueprint matching strategy to market live session. And what you're going to get for attending that, and both of these sessions are recorded, of course, so you can review them as many times as you need to, is handouts for the blueprints of the 8 most common option strategies. So you can start to master this matching strategy to market. Now, if I was to put a value on these because most of these we've talked about before, so before. It'd be over $400 of value, and today you just get it for 97 at hawkeyetraders.com/pro. So it's almost for that, just the blueprints. Really, as I've said before, I can't stress enough how matching strategy to market will serve you well going forward. It is the major thing with that I would attribute my successes to, and certainly those who I've had the privilege to work with over a number of years in a coaching context, it's really made such a difference to them. The no money down is an exciting strategy, and it's almost a why wouldn't you consider it. Even having just a couple of positions there working along in the background, you don't have to think about every 5 minutes. You've got clear guidelines for how to manage them. So really, it's an incredibly high value package, and I wanted to do that because I know that the guys, that Dan and the team here are really keen on offering something that's different to people who take the time and the investment to rock up and listen to the sessions that they put together. So just to reiterate, there's what's possible, and really it's one of these things that's not hard. We can unpick it step by step by step. I'll be on email for those of you who are going forward to do the next level course. You may be feeling a little bit, oh, I don't know whether I can cope with this. Give it a crack. I'll promise to be on email to answer any of the questions that you've got after the next session, so we can clear anything up and you can go forward and test it out. I mean, which is really the best way of finding out whether it's going to work for you or not. So I'm going to quickly just put this up just so you've got that, hawkeyetraders.com/pro. Really looking forward to working with you guys on the other side. There's also an additional offer for those of you who are interested in looking at joining us for a no-brainer price for the Hawkeye Options Trader Link Portfolio Service. But let's focus on that for now. I'm just going to quickly flick down the questions. I know we're running out of some time. How often do you lose dollars on this strategy? There are ways. It's a great question, John. Absolutely crucial is management of that sold call. If you manage that well and have strategies in place to manage the margin, then it really overall, I don't know anybody who's traded this as a long-term strategy and lost money, if that makes sense. So we did actually run this a similar course probably about 18 months ago and then just put it aside. But we teach to manage the risks. How long did these take? Yeah, look, just okay. We've got actually a few minutes left. I've just been reminded I run till 10:30, not 10:15. Apologies. So we're not under a lot of pressure. So we've got time to answer your other questions. For sure. Look, we can do a quick live one now if you want. We can have a look. Markets are looking slightly better than they were. Slightly better than they were with the futures. Give me a second. If we can just pause the screen, I'll just grab. Let's see what I can grab. Let's grab some. Just go to Google Finance because that's probably the easiest. Okay, we're actually liking Walmart at the moment for a potential position. So Walmart currently trading right now at 73.76. So what we'll do is we'll bring up some January Walmart options. I'm going to unpause the screen. Okay, so let's go through it step by step. Okay, so first of all, we like Walmart technically. Okay, so here's the January 2017, 15 minutes delayed on Google Finance. So if we look at let's say a 72.50 bought call, so we've got a 15-cent spread on that. We'll probably end up paying $4 for that. See the last traders at $4. We then go to a 72.50 put, and we see that again there's a 15-cent difference, 360. So the reason there is a 40-cent gap with this is that we're actually trading in the money. Remember, with the other examples, we were trying to trade at the money, but of course there's 250 increments between these on Walmart, so that's why it's not quite a no money down, but it's only 40 cents. We're paying for a exposure, one-for-one exposure for a 72.50 stock. If we were then to buy a $70 put, this is our protection we put in place at 270. Okay, so our investment in this is $270, $3.10. Okay, so minus 40 cents, and then 270 for our put protection. So yeah, so $3.10 is our investment. So if we were to invest 10 contracts, it would be $3,100 for this, rather than $73,000 for exactly the same movement in the underlying share, but with protection. Okay, so if we were to buy Walmart stock and the put at 72.50, it would cost us 73. Sorry, I've put it up with my panel. 73.82 is just clicked over to, plus 270, so it will cost you 75 odd, 76.50, and we're getting exactly the same movement, exactly the same protection for $3.10. Then we go to an August call. We'll look at week 3 August. We don't have to go to week 3 August, and then let's do a 75. We'd bring in $1 for that. So remember, it cost us $3.10 for the underlying position. That's protected right through to January. Okay, and for our first month's call, if we wanted to go out to August, we'd bring in $1.05. So that's 30, best part of 33%. We could just go a couple of weeks if we wanted. Let's do a $74. No, maybe that's a bit close. Let's do a $75 expiring June 22nd, so in a couple of weeks' time. We'd still bring in 30 cents, which is 10% for 2 weeks. Now, between now and January, we've got about 13 2-weekses, haven't we? So about 26 weeks, say. So if we were to manage to bring in 30 cents every time, times 13, then we've more than covered the cost of the initial position. Plus, of course, if Walmart is higher, then we make 1-for-1 on the underlying share as well. So if Walmart at the end of the day is $75, then we've made $1.14 on the share anyway. And we don't have to hold it till January. We can close it out whenever we want. We could actually put the place to put higher if we wanted. That's another variation. If we're coming into earnings for Walmart, what we might do is we might do a short-term put, a short-term additional put, just to give ourselves an extra layer of protection, which then we can cash in subsequent to earnings if we choose to. So that would be our Walmart position. Let's see how we're doing for time. I hope that's helped clarify things a little bit. Is that? Do you want to look at it? Would looking at another one be useful? As an option trader, the recent volatility is actually a benefit to selling options. look, it's not, as I said before, if we looked at our bull put spread example, we've got falling volatility, relatively high compared to the last few months. So it is actually quite a good market for credit spreads right now, but probably won't be for much longer. But we'll want to make sure that volatility keeps on dropping, so we can benefit from too. So look for, if you're looking at credit spreads, look for, let's just see what Delta's doing. Just have a look at Delta as a potential bear call spread. Currently trading at 34.31. Have a look at a 36.35 or even a 37.36 expiring a couple of weeks from now. For bull puts, would look very short term. Would be looking at 2 weeks, 1 or 2 weeks away. For bull calls, August would be looking at August series at the moment. James, fantastic, welcome. Let's look at Facebook Live, absolutely, Willie, let's do that. Facebook, so Facebook, one of the examples we just talked about before there. So there's Facebook Live, 1447, look at the options chain. Let's go to December. So if we look to 115, let's say 875 for our ball call. 115 is 115 put would be 950, say 945. So what's that? That's about 80 cents or so. I'm trying to work really quickly. About 80 cents. That's 720 for our put. Okay, so we're down at 640 investment in total. If we look to our August 19 call, come on. So if we looked at 120 there, you see you've got 220. So there again, it's about 30-odd% vestings. What did we say? 640 or something. I think that's what we said. We're bringing back in 225 maybe for a sold call at 120. Lots of upside potential on that. If we're looking a couple of weeks out, let's just look at. Let's look at maybe a 118. We could do 50. We could bring in 50 cents, 52 cents for a 118 call for a couple of weeks out and go a bit closer. Or if you wanted to just play nice and easy, you could just do the 120 for 24 cents maybe. There you go, Willie. You don't get called is the bottom line, Enrico. You take every effort to make sure you're not called away. So particular care around about ex-dividend date, and obviously good management as it comes up to expiry. You're very welcome, Willie. Okay, so let's just summarize what we've seen. So what we've seen is we've seen a strategy which we've got a no money down or pretty close to no money down investment. Sometimes it's slightly positive, sometimes it's slightly negative. No money down investment with a put protection, which means our risk is capped. We then subsequently sell calls over the top on a weekly or monthly basis, and of course we can do that anywhere. But there are 6 key things that you need to know about the sold call. There's another 3 fine-tuning strategies once you've mastered the basics for things like managing the position around earnings. There's some extra rules in the game in terms of setup, best time to enter, and also some extra rules like the ex-dividend stuff, etc., etc. So, okay. So look, guys, I think we're just about at our time. just looking to see if there's any more calls. Remember, HawkeyeTraders.com/pro. There is a special offer to potentially join us in the trade alert and portfolio service that we run. For those of you who join us, we're running these within the next couple of weeks, but as I said, there's 2 immediate on-demand courses, so we've put together a fantastic value kit for you to join in. And so what I'll say now is, for those of you who are joining us, really looking forward to working with you on the other side. As I said, you'll get 110% from me. Once we do the live sessions, I'll be there afterwards to make sure that you've got exactly what you need to from the time that we've spent together. Secondly, of course, wherever you're from and whoever you are, it's been an absolute pleasure and privilege, as it always is. I feel very blessed that you've taken the time to come and listen to what I've got to share. And finally, of course, good luck. I wish you well. Trade safe and trade with passion, and learn. It's the only thing that makes a difference. There's no shortcuts in this game, guys. So go for it. Enjoy, have fun, and thank you once again so very much to yourselves for attending, for your fantastic questions throughout, and of course to Dan and the gang for inviting me to come along and share this time with you. You're very welcome, Tim. Very welcome. I'm okay. It's not too bad. It's 10:30 at night, so I'm not too bad, James. Thanks. But it's sort of getting that way. Okay, guys. We'll see you again soon. I'll leave that up for a minute or two for you, so you can you can take advantage of it accordingly. But I'll say bye-bye for now.